Welcome to the Real Estate Investors Weekender podcast. This podcast is brought to you by the award-winning editorial staff at NREIonline.com. Let's jump right into this week's top news, features, and blog posts.
Hello and welcome to the NREI Weekender with your host, David Bodamer. Let's dive into this week's news. Good afternoon, David. How are you?
I'm doing well today. How are you doing?
Ooh, fantastic. It is a wonderful day. And I know a lot's been going on this week, and you're here to bring us all the updates. Where are we starting today?
Yep, another full week of news for the industry. So this week, the podcast this week is a little bit more focused on finance and investment. I picked out some stories that have a little bit of a theme to them that way, especially in light of something that we've talked about, I think, at the beginning of last week's episode about this whole issue of the yield curve inverting between long-term and short-term treasuries, and that's traditionally a benchmark that's looked at as a potential harbinger for recessions. But the yield curve is also, or treasury yields are also very important for the commercial real estate industry, independent of that happening, just because it's a metric for measuring cap rates, as like a threshold of where real estate sits as an investment relative to safe long-term bonds. It also could be important for how it, what it could mean going forward for financing and investment volumes. So I think that's kind of like a jumping off point again for us. The first article we had one of our reporters here specifically talked to some experts about, just straight out just asking them, what does this yield curve inversion mean for commercial real estate investors? Is this necessarily a positive, a negative, or a net neutral for the industry? So what we again, it's this thing that triggered a whole lot of discussion in the broader media and the broader business media. But what does it mean for us? So I think ultimately what we found is that it may not necessarily mean, I think one of the interesting things is that the yield curve, a lot of people are suggesting that maybe in this case, the yield curve inversion doesn't mean what it's meant historically, in that maybe it's not signaling a recession coming, or if it is, maybe it's a mild recession. But also when you compare the commercial real estate industry, when you look at it irrespective of what's going on with the broader economy, we're kind of in the commercial real estate industry is in an okay spot. That overall investment sales volumes are kind of chugging along, deals are happening. Cap rates are pretty stable, maybe moving. Lending volumes are pretty stable. So maybe this isn't something that is necessarily disrupting the way that our business is functioning on a day-to-day basis right now.
Got it. Yep. That makes a lot of sense. I was talking to an advisor yesterday, actually, and we talked a lot about the yield curve inversion and what that can possibly signal, so on and so forth. And it's the same thing with him. He's saying it could, but it might not. There's it's still kind of a guessing game, and you want to be, cognizant of it, but not necessarily let that run what you do. So kind of sounds like kind of the same thing.
Yeah, I think that's kind of the sense. And I think also whereas in previous cycles, there's been some potential red flags within the industry itself that came alongside with the onset of the recession, which then, exacerbated some of the down cycle for commercial real estate. This time around, we're not as worried about that. Pricing hasn't gotten out of control, lending hasn't gotten out of control, development hasn't gotten out of control. So recession clearly would affect, it's going to affect any industry. It affects commercial real estate because there's an effect on the underlying demand for the tenants of any kind of property type. But perhaps not the kind of not kind of some of the disaster scenario that we saw during the Great Recession and some of the problems that we had within real estate then, or not the same kind of problems that we had, I want to say, in the 90s downturn for the sector, where we had a huge problem of overdevelopment occurring, and then it took a long time for that to kind of wash out in the industry.
Mm-hmm.
And one positive thing on the flip side, here is that when long-term treasuries get bid down like that, it does actually lower lending costs since a lot of times, since for some loans, the loan is set at a spread to treasuries. So treasuries go down, your borrowing costs go down.
Makes sense.
Yeah. So, and as long as that doesn't get too frothy, as long as money doesn't get too cheap and encourage too much risk taking, I think overall, when people can lower their borrowing costs, that gives them some opportunity to get better returns on their investment.
Yeah, more bang for the buck, for sure.
Yeah. So I think like what you were saying, I think overall, I feel like the takeaways that we're getting at this point is, all right, this thing happened. This is normally a red flag. We should be aware of it, but also let's look at but it's like in and of itself, it's not the cause of anything. It's like, it's like correlation does not imply causation. The inverted yield curve is not going to cause the recession, but what is it signaling about wariness in the market and what could be causing that? And maybe it is the things like the trade war that's happening, people, that's creating some uncertainty and some nervousness. We don't really still know what's going to happen with Brexit. We got the protests in Hong Kong. So I think there's in some ways maybe some wariness in the market just because there's some things causing some real uncertainty, and uncertainty obviously affects investment decisions.
Yeah, absolutely.
So that's kind of like, I think that piece sort of is a good, was meant to kind of give us an overall sort of like, snapshot for where we are right now. What do some people think? The next piece that we wanted to look at is we interviewed Jim Costello, who is an executive with Real Capital Analytics, which is one of the handful of top data firms in the industry. They're one of the firms that measures investment sales volume any way you want to look at it, by property type, by region, by asset quality, and so they're always like a good to check in with. They also are one of the there's a handful of people that produce overall commercial property pricing indexes, and so so that was one of the things we looked at. The newest reading came out, showed that when you look at all commercial real estate property, the price index is up 6.3% year over year. It also rose from June to July by 0.7%. So, given everything we were just talking about, the backdrop of some questions, commercial real estate pricing, there's been at least in the most recent numbers we have, no disruption. At least in terms of prices. They did note, however, that investment sales volume in July fell by 21%, or $32.8 billion. So pricing was stable, volume dropped. But again, we're talking about month-over-month numbers. So it's a question of like, what does that mean? And it's just maybe at this point it's just something to note as opposed to necessarily like a red flag or a green flag or anything like that.
Did he have any comment on why? I mean, falling by 21% seems like a pretty good sized percentage. Is there data showing what it does year to year? I mean, I don't know if the seasons affect it, depending on because of development and everything else.
It's not necessarily seasonality. I mean, that doesn't affect investment sales volume so much, but what kind of, I think sometimes when we get granular in month over month comparisons for deal volume or even year over year, is that if, say, a year ago some massive merger got completed in this month, that's going to like create some noise in the numbers because or even just a very large portfolio that may have got traded a year ago. That doesn't tell us as much as what's happening with maybe like just the general run-of-the-mill smaller deals that would comprise a big number of transactions, but then may not move the needle so much on volume. So I don't know. So I think doesn't necessarily, like, I think just looking at a 1 month drop either year over year or from month to month doesn't necessarily tell us that much.
Yeah, got it.
I think we also did ask him about, we did ask him about interest rates. We did ask him about the yield curve. He said in terms of like the Fed lowering interest rates, that it could have an impact on the pace of sales rather than the prices in this case.
Okay.
That maybe lowering the interest rate may may accelerate some people being able to buy. And there's also the question of whether the Fed will cut rates again. And while he didn't want to chime in on what he thought about that, he did point out that in observing what other people are saying, that there's generally an expectation at this point that the Fed may cut rates again, but it's not kind of clear cut. And then what would that mean is, that money that's searching for yields, if interest rates get cut, that means that the yields on real estate may become more attractive. That's one of the potential ways things may be going here.
Gotcha. All right.
In terms of then like I said, we asked him specifically about the inverted yield, and here I want to just quote him directly, which is what Jim said is, as an indicator, I wonder if it has the same explanatory power when the forces driving that relationship today are different. You just have that crush of capital, and the U.S. is the only place in the world where there is a positive yield on that long side. It's a safe harbor. And it's different from the 1970s type of downturn when firms overproduced and needed to pull their inventory back. It's just a different situation. So he also, then went on to say that it could be something to worry about, but generally, if there is a recession, expectation of it being short and shallow, not necessarily translating to fear on the capital side, and could see the commercial real estate industry kind of just getting through the downturn without much pain.
All right.
And in terms of any last takeaways that he had about the latest numbers from the CPPI, he pointed to that the industrial sector is the leader. It had 14% year-over-year price growth, and wondered if that, the one potential risk there is if you bid industrial properties too aggressively, that can then maybe be an incentive to developers to try to build too much more of the stuff because they're trying to, they'll want to try to sell it and for the prices that they're seeing. So, it did raise a little bit of a concern about that, and that's something to look at in future months, whether the prices on industrial assets continue to go up at that kind of a clip. At the other end, he said, retail is very flat, very little price change year over year. And, which is not necessarily a surprise given the continued troubles we've talked about in the retail sector. But, just wondering what that might mean going forward for the sector. If there maybe are some places that there are assets that are okay relative to ones that are maybe, on their last legs.
Got it.
Jim had a lot to say. I'm not going to kind of keep quoting from this piece. It's a long article, long interview. People should go to the website, read about some more of his insights.
Yeah, they can get the whole thing there. So that'll be perfect. All right. The next story, the title is Life Companies Find CRE Lending Opportunities in a Volatile Market. What's going on here, David?
So here, I wanted to take an opportunity to talk to the life insurance companies who have a pretty robust business in lending to commercial real estate, and just kind of get a sense of where they were at in the cycle, because they tend to be historically, life insurance companies are very conservative about how they lend to the sector, where they want to lend on the best assets. They do offer very competitive pricing, but they want their loans to perform. So they're not going to, they want good credit borrowers. They want good assets, long-term leases. No real, they're not a fan of risk.
Yeah.
when it comes to data, because it's like you think about it, it's like they're putting some of their book here, some of their book here, laying into commercial real estate. They want to just get that income they can get off of those loans and use it for their core business.
Yep.
So this was a chance to kind of like, we like to every so often just talk to them, see what they're doing. And what they're seeing is that, like, with some of this volatility in interest rates, they actually see an opportunity to pick up some loans that they were losing out on, and trying to be a little bit more aggressive than they had been in the past. Like some of them are offering rates now as low as 3%. Again, lower interest rates broader interest rates allows them to offer lower interest rates on their loans, so they can get a little more competitive on loan pricing. Some of them are also trying to add some flexibility for borrowers that they maybe hadn't done in the past. Things such as giving more flexibility on prepayment options, and things like that. So some of the terms that maybe in the past they wouldn't have done. And on the plus side, what they've always offered to borrowers is, if you're going to a life company lender, the deal's going to close. They're stable institutions that are very by the book on how they get out and do these deals. Mm-hmm. So talk to a couple of some of the chief investment officers or the chief loan officers at a couple of the insurance companies. Heard a similar thing from all of them, that they see this as an opportunity. They want to try to a way to grow their volume, and because it's also I think one of the more remarkable statistics looked back at how they're doing is that currently life insurance companies are reporting an average delinquency rate on loans more than 30 days past due at 0.002%. So that just gives you a sense of the deals that they've done in the past, in recent years. They have no issues. That they're good at picking. They're good at picking their properties and the borrowers that they're lending on.
Yeah, it's pretty good statistics.
Yeah, I mean, in general, delinquency rates are pretty low for other, pretty low in general for commercial real estate. But I mean, look at, I think we talked about CMBS delinquency rates a couple of weeks ago, and we're looking at 2-3% in some cases for some of the property types, and maybe 4 or 5 for others. So it's but general 2 to 5% range for CMBS loans, a little bit lower for commercial banks, but life insurance companies essentially reporting no delinquencies on their loans right now.
Yeah.
I think for them too, that when in the way that the market's gone, some of them have had issues hitting their volume targets just because they have faced so much other competition from some other lender types. So I think, that's again why maybe they see this as an opportunity where other lenders maybe aren't as comfortable with the volatility or maybe can't deal with the pricing changes. Life insurance companies may be able to step in a little bit. So I just think in general, they seem like they're in a good spot. They seem like they want to grow their business, so they're planning to be active, really active as lenders for the rest of the year. Again, there's some more detail. I think we talked to a couple of good, again, we talked to some good folks for that. So I think if a lot of people want to read more in depth on on what they're doing, what they're saying about their books, what they're saying about their volumes, they should just go check out the full story.
Mm-hmm. All right. And we come into our last story, and that's I actually am very, very interested in this because I just like to watch behaviors because of things that happen. Should landlords worry about drugstore closures? And what drugstores are we talking about here?
Yeah, so we're talking about both Walgreens. Walgreens announced recently that it's going to close about 200 stores. And then the next day, CVS announced that it's not necessarily closing stores, it's closing some stores, but more relevant, they are slowing their pace of expansion. So okay. I think they, at one point, I think it previously had set a target, or generally they're opening 200 to 300 stores a year, and they're kind of tapping the brakes on that a little bit. So they're slowing the pace of expansion. Mm-hmm. So the question is, of course, when something like this happens, how is this going to affect the retail sector? And because I think it's very easy to, especially in the context of a lot of retailers closing stores, to see any news of store closings and think, oh my God, this is just another bad things for the retail sector.
Yeah.
In this case, maybe not so much.
Why not?
So, because when we're talking about drugstore operators, both of these, just to put it in context, both of these companies combined have about 20,000 stores. Mm-hmm. So when you talk about closing a few hundred stores, sounds like a lot, but as a relative percentage of their overall store portfolios, it's not that significant.
Yeah, and I was looking earlier just because out of curiosity, when we were talking, and Walgreens has just under 10,000 stores out of those 20,000. So This is what, 2% of their stores, which isn't a huge percentage, but like you said, people see it and say, "Oh man, here we go. We're closing down all these stores," and what's going to replace them as far as location, and also why are they closing? Is everybody going online? Canadian drugs? What's going on? We all get the emails, so yeah. So it's interesting, but yeah, it's only it is a small fraction.
Yeah, and I think both of their cases too, we're talking about chains that have been very aggressive in recent years in acquiring, both in opening stores as well as acquiring other chains. So at some point, you also could end up with like, all right, I'm sure you go down anywhere, sometimes you see the Walgreens, and then you drive 3 blocks and you see another one because it used to be like at the Rite Aid.
Yes.
Right?
Yep.
So there's also those situations where it's like, all right, maybe we don't need to have 2 pharmacies within this closer range. So let's just close one and consolidate.
Yep. No, that makes sense.
So I think that's been some accounts for some of the slowdown and expansion and closing. It just could be redundancies in the portfolio. I think in terms of then diving into some of the sales dynamics or what their business, I think what was interesting is that when it comes to the prescription drug business, I think their sales are fairly stable. They have taken a little bit of a hit when it comes to some of the front of store stuff, just like the general merchandising that they do now. There's just the competition they face from Walmart, dollar stores, Amazon. Because like you don't necessarily, you may pick up some groceries or whatever at the CVS, but that's not where you're doing that as a matter of course.
Yeah. So
I think they have felt some pressures from the retail, just the broader retail trends and their general sales. And I think, so what they may have to just reckon with is how to deal with any blips they face on that side of the business, balanced out by the strengths they might still have with the prescription side, or even with some of the offerings they're doing on, in clinics and other health services that they offer at some of the locations.
Got it. All right. Anything else on this one?
I think that's kind of like the main headlines for this piece. Just that I think the overall takeaway is but doesn't seem like, all right, this is like necessarily the beginning of they closed a couple hundred stores now and we're going to see another burst of them later. This might just be some fine tuning that they're both doing.
Yep. You can still get your prescriptions. It's not gonna change that. So, all right, David, thank you so much. That was great. All 4 stories wrapped up. Again, if you want more information about any of these, where do they go?
Go to NREIonline.com. And this was just a handful of the pieces we had this week. A couple other highlights that people may want to check out is we had a piece that looked at the most recent analysis of REIT CEO pay that was put out by FTI Consulting. So we had a piece on that. We had a piece just on apartment occupancy rates, what some of the latest numbers on that. We had a commentary piece this week that's kind of like a good piece for people thinking about what kind of financing strategies they're considering today. And then another update on CMBS delinquency rates, which I think I alluded to, but didn't want to dive into. So those are some of the other pieces we had this week, including a few others. So, you can read the full stories of the ones that we talked about in this podcast, as well as check out some of these other headlines.
Right on. And as always, we ask you to like the podcast, subscribe to it, share it with your coworkers. all of you guys can get some great information from NREI, and we appreciate you listening. So thank you for listening to the NREI Weekender with your host, David Bodamer. If you have not subscribed to the podcast yet, just click the subscribe now button below. It's nice and easy. This way, when David comes out with a new podcast, it'll show up directly on your listening device. Again, thanks for listening today. For everyone at the NREI Weekender, this is Aric Johnson inviting you back next week for all the news that matters to you. See you soon.
Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of NREI Informa. The content has been made available for informational and educational purposes only.